In 2019, I talked about uranium mining equity portfolio strategy and how to construct a good platform to express the upside in the uranium sector. Well, here we are again talking about our favorite fuel, uranium. So a small piece of value for the participants who are invested in this uranium cycle. We have this current topic, exit strategy considerations for the uranium investor. So we've got some, silly feedback really on this topic, including, why are you talking exit strategy when you haven't even gone through the uranium bull cycle? We can talk about exit when the spot price is $65 a pound uranium. We haven't rated the fridge yet, so why worry about the exit? Is exit strategy talking about my favorite color for my new Bentley? Come on. We're smart enough here to stay humble first, and we don't speculate about what we'll do until the deal is closed. So I'll leave the silly stuff for someone else to opine on. But just a few things here. First off, every participant in this sector has been graciously blessed with a good amount of time to strategize and figure out the best means and methods. So after years of evaluation, it's a shame really to see that exit strategy really hasn't come into the prudent discussion. Look, on another note, we decided to talk about this topic as really it's a matter that nearly nobody has covered. Furthermore, this exit strategy was covered as part of our nuke report, which had a key section on exit, initially put out in 2017 and substantially expanded in 2019. Now, we'll cover more detail in that report, of course, on this topic, and this presentation has some supplemental information that really should be considered in addition to our report. And quite frankly, why not put together useful information that nobody is covering? Well, every investor, whether institutional, retail, family office, fund, or otherwise, talks about investing in the uranium sector. Everyone talks about the entry, they talk about their reasons, they talk about the fundamentals, they talk about their favorite stories behind each company, their favorite people, their reasoning, and much more. Nobody wants to talk really or share their exit strategy. And this is the case for many reasons, really, including just not having a plan at all, which I suspect is the bulk of it. Buying is often the easiest part of investing, when in fact, it should be the hardest part. Selling should be easy, and it really is easy when you have a plan in place at the time that you were deploying your capital initially. So how can you be an investor and a speculator in the natural resource sector, a highly volatile sector, without a good firm grip on how you go about an exit? So I am surprised really about the comments that we got, which leads me more to believe that many haven't considered a real exit plan. They've not trained for it, they've not prepared for it. To think you'll cover it on the fly really is a bit naive, but maybe your skills are just exceptional. So do yourself a favor and start formulating your plans rather than making it up as you go along. Re-examine why you are in this position and make the corrections. This presentation, I hope, get your thought process better aligned. It's not everything, but it will push you in the right direction. I'd also point out that us, you, and everyone else participating in this sector won't be perfect in their approach, nor will they be perfect in their exit. That is why we plan the best we can, and we really want to reduce our mistakes as much as possible to optimize that outcome. I think that's the key. So going forward, we're bringing you a framework for exit strategy in this presentation so that you can have a plan in place now. So in this high-level presentation, we will provide you with a framework of indicators, triggers, and ideas of how to successfully execute your exit strategy when the time comes. Now, the setup required for exit. Term contracting is really the key that really leads to a number of other items that'll come down the pipe. Prices will come up to a level, of course, where the sector recapitalizes, and of course, restocking will commence. Existing production capacity will resume at some point. And as that all happens, notable new projects will be financed and built. And of course, production will eventually outpace consumption once again. And then, of course, with all this comes speculation, ramps up on price, and a lot of exploration work that'll be occurring due to the sector recapitalization. So that's all exciting stuff that's coming down the pipe. So from 2005 to 2012, an average of 178 million pounds was contracted per year, with total contracting around restocking approximately 1.4 billion pounds. In excess of 178 million pounds occurred for 3 consecutive years, and there was a total of 5 years overall during that period. So just a note here, the average operating reactors from 2004 to 2011 was 442 per IAEA PRIS data. The actual operating today is the same number, 442, less the idle Japan units, which is about 21 of them. Gets us down to about 421 units as things currently stand today and as expected near-term restarts that are happening over the next few months. I'd point this out because the similarity of then versus now. This cycle is no longer about demand growth. It's really, that's icing on the cake. The cycle is now about the supply debacle and how a broken supply chain gets fixed. And that's really simple with a lot of money. So the spot versus term, we've seen this before in the last cycle. The reason it doesn't matter so much right now during the low levels is we believe that the price reporters have artificially underreported the real term price, which we believe is in the mid 40 area. But here, the point is on the upside, where spot might be 80 while the term price is 60. During a real term contracting round, the term price will no longer lag and will be reported direct by the producers, forcing those reporters who are lagging to follow along or start leading the way. The excess and spot consideration here is really about market sentiment. And as you'll see on the screen here, really it's the likelihood that the traders and speculators will drive illiquid, lower volume spot price up. Now, when I say illiquid, that is really in comparison to the expected high volume action in the term contracting round. Now, number 3 here, spot exceeds 90 a pound. We picked 90 here as a broad point of caution that was under 100. At 90, that is nearly double incentive price and a price where, if sustained for a period or an area in which heavy term deals are done, provides enough reason for future oversupply. We saw term price get to this level last time, so it is reasonably expected to see the spot price here also at some point during the cycle. Now, the listed companies, right now by our count, there are about 98 listed companies, and really this is everything from those who claim to have a uranium project, explorers, developers, producers, majors, listed equity funds, physical uranium funds, the fakers, really those who have uranium in their company name, and those who have switched, from some other commodity or other sector like gold into uranium. Obviously, as this grows, we'll see increased interest in uranium with increased prices and more participants figuring out what is really going on in the sector. So we added this as a sentiment gauge. The market becomes forward-looking once the current reality is apparent to the majority. Looking at your screen here, number 5, this is where the spot price rises near par with separative work units and either is the same or exceeds it. Now, we saw that spot was near par with SWU during 2007 before spot price dropped back in line with what became an oversupplied market. Now, moving on here, secondary considerations. This one's really simple, the first one here. When we see the existing mine supply plus new capacity is on par with current consumption, that is an important point to be aware of. And again, because the market will become forward-looking, they will start to see that ahead of time. Next, the nuclear reactor accident. This is really a deal breaker for the uranium market and a bad event for the industry. While it is okay for coal plants to pollute and kill people, coal mines collapse, it is okay for natural gas pipelines to explode and wipe out residential blocks. It's okay, to fall from a wind turbine and have accidents during construction and maintenance of various energy facilities. It's okay to have oil spills, but for some misfound reason, it's not okay to have a nuclear accident. This presentation isn't about the safety record of nuclear. And of course, we can measure that in many ways in terms of time, energy produced, frequency, and number of reactors. But at a very basic level, over about 64 years of operating history, there have been 3 nuclear accidents. Now, that's 1 accident for every 21 years. Fukushima 2011 was the most recent, and as human nature would have it, the alertness around reactor safety post-Fukushima remains elevated even today. So while accidents are sad and we would of course never want them, they do happen. We as humans take calculated risks every day in our lives, driving our cars, flying our airplanes. We take risk in everything we do. We take risk really generating energy. We take calculated risks to do so. We take risk with our capital when investing in sectors like uranium. So the next consideration is a broad market decline later in the uranium show. We point this out with looking back at the last broad market decline in 2008 when the uranium cycle was in its late stages. The later stages is where it makes sense to get out while allowing some time for the broad market to sort itself out and while you consider the actual conditions in the uranium market. I just want to highlight that this consideration needs attention during the later cycle stages. While it becomes buying opportunities when sector fundamentals are in your favor, like what we saw in March 2020, broad market sell-off. Now, I want to point out that everything we just covered here is generally macro view conditions that will be much more important than individual company micro factor, such as valuation. However, this is not an excuse to not pay attention to specific company factors and to keep your net present value skills up to speed. Now, rules for exit. We need to have three simultaneous conditions need to really be present to justify exit besides the clear exemptions shown here. Now, the SmithWeekly override is our form of a judgment call to exit. We reserve this trigger as really a method to make overriding decisions based on actual future conditions in the market and the actual future unknown situation that may not be predicted or expected at this time. As we detail further in our sector report, we need one other primary consideration in place before exercising this option, really as the final override to get out. Micro factors is another area where we'll utilize discretion. We continue to believe that the macro factors will be key, but micro will apply individually to each individual equity. Well, thank you for tuning in. We appreciate that. Our most useful contact information is shown on the screen, so please reach out if you have any questions or want to get a copy of our report. That about wraps it up. We think participants in the sector should keep an eye on exit strategy planning, and this presentation provides a solid foundation to do so. Don't get caught up in thinking you can figure this out when the uranium price is much higher in the midst of a late stage bull market. Really, we've had time to think this through. And, I would just say, why not go ahead and apply some of these thoughts and some of these planning, tools now while the time really is still on our side. We have time to go through these things, so why not go ahead and do it before, time gets away from us. So here we've really given you the framework and roadmap via this presentation and, of course, in more detail in our nuke report and the various subsequent presentations that we've provided on these various topics. Now, at this point, it's really up to you to implement and finish the job. In the meantime, keep the faith, stay the course, and take care.